we have the chart of ExxonMobil, and I think a very interesting thing in analysing charts is the idea of support and resistance. And we can see this particular chart here, and I've drawn a number of lines at levels that I believe to be just that, support and resistance. Now, as we know, the idea of support is a particular price level in a chart where the price almost seems to receive some support from it. The price seems to literally bounce off that price level as if it's hitting the floor and then bouncing back up again. And the opposite, of course, is resistance, where it almost appears as if the price level is providing a ceiling to the prices heading any higher. So as the price moves up, the price literally bounces back off and heads back down below again. So here we have a situation at $55 where on several occasions the price has bounced off and then moved back up to resistance level here at 65, and notice how likewise it's literally met resistance and the price has not wanted to head up any higher, bounced back off again, had another go at it, bounced back off, had another go at it, bounced back off. So we are literally seeing a ceiling placed at this level for the price to move any higher. And before I talk just quickly about how that resistance comes about, many would think about perhaps buying when they see a stock that they like as it's approaching resistance, to get in a little bit lower than perhaps above the resistance. And this to me is where probability enters the scene. Because let's say we saw this price heading up towards $65 and we wanted to go long and enter a trade in this particular stock. I personally would wait for the $65 level to be cleared before entering, because to me, once the price had reached here, it had a higher probability of becoming a profitable trade. Whereas if we buy it back down here, of course the obvious argument for that is you can pick it up for cheaper and therefore make more money on the trade. However, I also believe the counter to that, and really the disadvantage of doing that, is the resistance level that has proven itself time and time again is yet to be cleared. Therefore, the probability of this being a profitable trade is nowhere near as great as if you had perhaps purchased it a little while later, once breaking through that resistance level. What we also know is often when resistance is broken, and here's another one at 70, often when resistance is broken, it becomes a level of support. And again, we've got resistance here at $80 odd, it's broken through, and now we have levels between $80 and $95 where the price is literally just moving back and forth and bouncing back and forth between those levels. Now, why do we see these support and resistance levels often at round numbers? And I mean multiples of 5 or 10 or perhaps 50 cents or something like that. And I think it all comes back down to the way in which we like to think about prices. It's easy for us to think in round numbers. And rather than putting an order in for $4.03, we'd put an order in for $4 because it's easy to calculate, it's easy to think about, and therefore we have a tendency to gravitate towards round numbers. It's just a human tendency, and we see it very much in the markets. And if you look at the depth of the market and see the buyers and sellers for a particular stock, you'll often find large congregation of people waiting to buy and sell at these round numbers. So of course, as the price moves back down here to $55, the reason why it bounces off and receives support is because we have so many people in the market with their orders in to buy at $55. So there are simply not enough people to sell to consume and provide sufficient selling of shares to all those people waiting to buy at $55. And if there's simply not enough sellers, there are still people waiting to buy at $55. And if those people are not satisfied, then the price will not fall below that because they're still waiting to buy at $55. Likewise, when the price comes up here to $65, there are people queuing up, literally jumping on top of each other to sell their stock at $65. So we have a lot of people waiting to buy at $65. If there is not enough demand for stock at that price, those sellers will remain unsatisfied or dissatisfied. They simply won't have their shares sold. So they are still waiting to sell their shares at $65. If there is not enough demand, not enough people wanting to buy at $65, the price will simply not move 1 cent beyond $65 until all those sellers are satisfied. Now, when we do see a break through one of these levels, and we notice another little congregation here, and then finally a breakthrough, clearly all those sellers at $65 have been satisfied. There's obviously been enough demand for stock at $65 to consume and satisfy all those sellers and take up all those selling orders, or those sellers who had their orders in at $65 have maybe changed their mind a little and now see a positive outcome for this stock and therefore decide to cancel their orders to sell because they wish to hold on to ExxonMobil just that little bit longer. Or of course it's probably more so a combination of both. But a couple of things with support and resistance. The first one is, just because we're meeting resistance doesn't mean we'll ever get beyond it. We may belt our head up against $95 here for a long time and fail to move beyond that level. And you can imagine, after a period of time of belting our head up against this ceiling, try to break through, people lose interest. And that's why sometimes we never break through this resistance and prices just fall away and never reach that resistance level again because people are sick and tired of banging their head up against their ceiling and not getting their way through. But the other thing with support and resistance as well is if we look at this trading range between $80 and $95, for a more medium-term trader, they're probably not going to enter a trade until it moves beyond the 95. Just a simple approach of a new all-time high, and you know, the sky is the limit beyond that point there. So a more conservative medium-term trader probably wouldn't be interested in this stock and hasn't been for the last 12 months or so. However, at the same time, you would have people who trade quite short term and perhaps use some leverage who may have traded this several times in the meantime, in those 12 months. They saw it bounce off $80 and they've traded it up to 95 here. They've seen it fail to get through, meet resistance and really struggle, therefore exited their position, estimating or forecasting or considering the possibility of this returning back down to $80 again. They've entered a short trade, been exited here, perhaps traded it back up again, down again, up again, down again, and you get the idea. There would be a lot of people who would literally see this period of consolidation here in the movement between support and resistance and enjoy the ride up and down and back up and down again and trade it several times in that 12 months, whereas others perhaps would never even look at that particular stock because the manner in which it's just moving sideways and just moving between two support and resistance levels.